Hi, Trader Michael here. Today we will talk about the risk involved while trading on financial markets. We will discuss the ways to manage them through diversification, technical methods, hedging, and how to develop your own risk management system. So buckle up your seat, cause it's gonna be really interestingly boring. Just kidding, of course, but it will be a longer video, so prepare yourself a good cup of coffee and let's get started. So when talking about risk, we need to realize that losses are inevitable. They can occur due to market makers' manipulation, bad or invalid technical or fundamental analysis, and an external force of measure. As an example, we have a situation from 2015 when the Swiss National Bank suddenly announced that it would no longer hold the Swiss franc at a fixed exchange rate with the euro, as it has been doing for the past 3 years. This caused a massive panic, which resulted in an increased price of Swiss franc against the US dollar and euro by 30%. This was a huge disaster. Many traders were stopped out of their trades, also many brokers suffered, and some of them even had liquidity problems. Probably some of you remember this situation. So, the moral is that we can't avoid it completely. Our task is to minimize its effects. There are a couple types of risks in FX trading. The market risk. This is the result of factors affecting the price or our incorrect analysis or forecast of the current market situation. Next is technical risk, which results from technical problems or malfunctions of the platform, orders execution, and brokers fraud. Another one is psychological behavioral risks. Those risks concern our mental approach. If we make bad trading decisions because of our mental condition resulting from too much stress, fatigue, fear, or maybe greed. And yeah, in this video here I will be talking about the trading or market risks only. So where do trading risks come from? Firstly, errors in market analysis and forecasts. Any data release, Fed statements and economic assessments, meetings of other central banks. All this influences the price, and the key thing is to correctly assess the importance of these events. Traders always need to look for the bigger picture. Many times the errors come from missing something significant. Second, the force measure. By this I mean something external like an unexpected political decision, man-made disaster, launching a new product by the company, unexpected sudden bankruptcy. It can have both short and long-term consequences. For example, dot-com bubble in early 20s and the 2008 mortgage crisis in USA, which became global. Naturally, not everybody lost during those crashes. Some people made huge money. It is well described in the movie Big Short. Most probably you have already watched it, so for those who didn't, do check it, it's worth spending the time. Next we have a human factor. It is purely our fault when we incorrectly interpret the patterns, signals, etc. due to stress and inattention, taking trades just to click on something, etc. So okay, let's talk about the technical analysis problems in more detail. First point is high volatility at the time of entering a trade. So when the amplitude of price swings is high, the faster you can earn on it, but it also goes the other way around. If the price will go against you, you can lose even more. Solution to this is to identify the volatility visually. Check the distance between opposite fractals extremes. Second, we have horizontal levels trading strategy, i.e. trading based on support and resistance levels. Some traders use it for breakout trading. Some are expecting an opposite move that the price will rebound from such level. Some uses those levels to set stop losses. At those levels there are so-called turbulence zone. It is not effective to try to predict the direction when the price is moving in a small amplitude. As an advice, I would recommend to use them rather as a reference. Try to avoid setting stop losses around those levels. They will be often used by market makers since the majority of the traders use them this way. If you already entered a trade and it is slowly getting closer to the strong resistance support level, it is better sometimes to close the trade a bit earlier to avoid a strong rebound, especially when there is going to be some news release soon. It all comes down to if the rebound or breakout is a true trend or just a correction. Third, entering trades in overbought and oversold zones. These are the moments where big traders are exiting trades and taking profits. One of the most popular methods to determine those zones are with the use of stochastic and RSI indicators. Remember that these are lagging indicators. Even if you use them correctly, it doesn't mean it will be efficient to minimize the risk. There is no flawless indicator, so be careful with interpreting their signals. What I recommend is to check when we have bigger volume. It can be tick volume also, which represents a big amount of orders. And candlestick which is created looks like a doji. It shows the fact that there is not much buying power to push the price higher. The market is run out of steam and too many orders of profit taking most probably. Fourth is entering a trade without a clear ongoing trend. So during our flat movements, very often we get caught in between because we fell for a local swing and thought it can be the beginning of the end of a sideways movement. It is very difficult to get rid of those mistakes completely, even for more experienced traders. Here what I suggest is the same thing as in the previous case. Look for the volume that was not seen recently. Each bigger breakout candle should be confirmed with a bigger amount of new orders. Candles at best should have small or no shadows at all, and overall we should see a narrowing movement to create some kind of a triangle or wedge. So fifth, wrong indicators parameters. Results, as you might guess, are incorrect signals. Solution is to always, before using some indicator, do a backtest manually or in strategy tester on MetaTrader. Sixth, famous pending orders. Thing with the pending orders is that they are set more based on intuition rather than a real price movement assessment. Traders should react to what they see on the market and not predict it with a crystal ball method. Of course, there are strategies where the pending orders are the key. They are called grid strategies, when you set the pending orders on the boundaries of the price channel, wishing that the price will bounce back every time. To reduce risk, I would rather avoid using pending orders. So, seventh, sharp price drop during long position opened. Situations like this, when the price is moving 500 to 1000 points in a few minutes, is very rare, but it happens, and it is impossible to avoid it. Take a decision and set a stop loss order, always. 8. Infamous market makers. They are big players who move the markets with their huge capitals. On top of that, your stop losses and pending orders are visible to them and of course used against us individual traders. Most of the traders set their stop losses at local price extremes, round levels or support and resistance. What they do is, for example, push the price toward your stop loss level despite all the forecasts, trigger most of the orders and then go in the right direction. Sounds familiar, right? What we can do is, of course, do not even try to fight market makers. Rather, try to pay attention and learn where potential zones of concentrated orders are and try to avoid them. Have in mind also that indicators don't forecast the possible market maker actions, so you should trust them less. Focus on patterns, exchange informations, i.e. trade volumes and table of orders. As for recommendations to improve fundamental analysis, I have just few. So first, do not trust blindly what is said on mainstream media, especially forecasts of experts. Start using economic calendars and stock screeners. Estimate economic data, compare it with the expectations of analysts with the previous reports. I could also add something about hedging and locking, which is in trading FX basically the same thing, but I made a video on it some time ago, so I will just invite you to watch my previous video. So that is all. Remember to check the video description and see you in the next one. Cheers, bye.